Good afternoon, guys, and welcome to the podcast. I'm really delighted about today's guest, Chris Vermeulen. He's from the technicaltraders.com. Today's talk is going to be all about financial literacy, the markets, investing, trading. I'm really happy to have him on to add value to the audience. Chris, welcome.
Thanks for having me, Christopher. Pleasure to be here.
Yeah. Briefly introduce yourself, and I'm excited to dive into the questions.
Sure. Yeah. So a little bit about myself. Long story short, I grew up in the country with no TV, and all I did was play in the woods and build stuff. And when I went to college in Toronto, I got hooked on TV, and it was CNBC at that time. And my dad had also got this little package in the mail at the same time I went off to college about trading futures from a popular trader. And I read this thing about how you could make money trading futures. And then I saw CNBC, which I was addicted to two stations on TV. It was Speed Vision and CNBC. And I was like, oh my gosh, I want to learn to trade. This looks amazing. I could do it from a computer. This was back in 1997. So computer and internet was pretty fresh. I was like, this is amazing. And that really sparked me. I asked my roommate, he was in web design. I said, hey, if I learned to trade, could you build a website and I share my trades with other people? And he says, sure. So I started learning the markets. Along the way, I've traded almost all styles of trading and investing you can imagine, from scalping, day trading, futures, options, Forex, you name it. I've done full circle. And I've blown up 3 trading accounts, 3 investment accounts along the process. I've learned bull and bear markets are opportunities, but you have to have your head screwed on straight to know how to trade them. And everyone sees the markets differently. And I found my sweet spot, the way I perceive the markets, how I find a way to allow me to pull money out of the markets, pretty much like a side business. It's a great way to almost have a business running for you when you have a strategy. It allows you to have your normal job, and then you can invest on the side and grow accounts. I got really involved in the markets from there, and I've been learning ever since. And that's my whole passion, is to help others learn the markets, avoid chaos, and not blow up their accounts so they can be more free to do what they want.
Interesting. And yeah, really great introduction. And first question is, your technical traders, who comes to you for, you've got books and courses, you got a blog, your services. Who is your client avatar?
Yeah, our key avatar really are generally 45 plus years old professionals or retired entrepreneurs, people who have been around the block. They have tried all kinds of styles of investing, and they've already saved up wealth. They already have money that they don't want to lose. They're close to retirement or retired. I provide a strategy that once people see what I do, then experience of the kind of what it's like, they feel like, oh my gosh, this just makes sense. I wish I found you like 20 years ago. So what I do is more or less, I help people who have wealth and value their time, who want to protect their lifestyle. I help them navigate these markets so you don't have to really worry what's going on with tariffs or the president or market corrections. And I found a way to consistently grow our accounts, pull money out, and preserve and protect people's retirements. So you don't really have to worry about this big bear market that is always looming and people are worried about. And so that's who I help. I help people with money keep it and not have to spend time learning the markets. They don't need to spend time trying to trade and all of that stuff. It's pretty much I do everything for everybody in terms of here's what needs to be done. It can be executed for you, or you could do it yourself. So that's who I help, is generally people who have a good lifestyle and wealth built up that want to preserve both of them.
Interesting. And one of my questions for you is, what's your unique investing approach and how do you outperform the market?
Yeah. So the 2 ways that everybody knows about is the typical buy and hold portfolio. Guaranteed you're going through a roller coaster, multiple roller coasters through your lifetime. Guaranteed you'll never retire early because it requires about 40 years to really grow some real wealth. So I'm not a big fan of the buy and hold strategy because we can identify if something is going up, down, or sideways. So why would we hold something going sideways or going down? That's one way that everyone knows. The other is to be an active trader. People think day trading, swing trading is a way to make a lot more money. In fact, the reality is the more you trade, the more you lose in general. It is not an easy game. And so I've created this new category, what I call asset revesting. I've written a book on this. It's right in between. It's active investing. So the way I look at stuff, Christopher, is like the market. I look at it like the ocean. I live on the water. I surf, I kiteboard. I like the ocean as the analogy. The The stock market is like the ocean tide. When the tide goes up, what happens to all boats? They all go up. When the tide goes down, they all go down. And if you own stocks and we're in a bull market, on average, you just throw a dart and those stocks are going to go up. Now, some sectors and stocks will go up more than others. If you do proper research, you can find which ones are hotter, the hot ones to own. But when the tide's going down, you don't want to hold it. So understanding, are we in a rising or falling environment, is number one. And then the next most important level is actually to look at the markets like a surfer. So if you're walking down a beach somewhere on the ocean and surfers floating out past where the waves are breaking and they're just floating out there, what are they waiting for? They're waiting for that next set of waves to roll in. And every year there's about 5 to 12 waves that roll through the stock market, the bond market, through various asset classes. And the nice thing about these big waves, these sets that roll through the financial industry, just like the ocean, you can see them coming. You can get your position. You can get figured out which wave is good for you, which asset fits your criteria. And then you can hop on and ride that wave. And the nice thing about catching a strong wave is that you also know when it's starting to weaken, when it's starting to break. You need to get off that wave before it curls and takes you down into the washing machine. So that's what I do, is we actually sit in cash 30 to 40% of the time in the year, just collecting interest safely on the sidelines. So we avoid a lot of chaos there. But then when we get into something, it's got a strong trend and we see growth and it pushes our accounts up. And so we can always be in something that is paying us money. Even when we're sitting on the sidelines, we're still earning our 4.5% safely on the sidelines. When we're in a position, we can make 3, 5, 10% in a ETF trade, which is a fund that allows us to put all our money to work very easily and ride that wave through the market. So I call it asset revesting because we're constantly reinvesting our money into a different asset. And our money's just rotating as the waves roll through the markets. And we hold either stocks, bonds, currency, or cash. Those are the key asset classes. We don't get into individual sectors or individual stocks. We just focus on what the overall market tide and waves are doing. And we catch those bigger picture moves because they're much more accurate and they last 3, 4, 5 months, which make it very much easier and less work to have to place trades, because we don't want to trade. We want to trade the least amount possible, make the most money possible, and have the smallest amount of downside risk.
Yeah. Yeah, because one of the questions from the audience was, because you have a lot of high net worth and they've invested well, real estate and just long term, and then when they're retired, it's now you want to, it's oxymoron for them to learn day trading, which
it's the wrong thing. It really is.
Yeah, so really interesting. And the next question I have for you is, with these, how do you address with these, because you're using the tides and the waves to make additional cash flow? How do you address the tax implications for clients?
Yeah, obviously, when you make money, you got to pay taxes. It's seen as trading, so you do have a higher tax bracket. But as my dad always said, is the more taxes you pay, the more money you're probably making, right? I know if you're a taxman, you're probably cringing. There's a fine line there. But the reality is, if you're a buy and hold investor and say you're 55, 65, you're in retirement or darn close, and then say the stock market goes into a 4 or 5 year correction. We go into a bear market, a real one that we see a 35 to 55% correction. It's happened many times in the past. That is not only going to be very costly because you will have lost half of your wealth, the stress that comes with it, the downgrade in lifestyle, all of that stuff. Yeah, you're not paying the government tax, but you're paying a lazy investor, non-skilled, you're paying a high risk and strategy tax. And it can take 5, 10, 15 years to recover from that. Really, the NASDAQ took 16 years to recover from the tech bubble. It took 12 years for the S&P 500 to recover from its major correction. So that is a long time if you're close to retirement to lose almost half of your money. So the way I see it is, hey, the strategy that I deploy, we make 2 to 3 times the average return for the buy and hold. So we're making 12, 14, 16% a year. I don't mind paying taxes on those gains. It might knock obviously the returns down a little bit, but we don't ever have to suffer through these massive drawdowns. So I'm all about consistency. If we can just pound out a good return every year and not have big losing years, we're still ahead of the game from a tax perspective. And we don't have the downside risk and we don't have the stress at night. A lot of our investors are always like, oh my gosh, it's so nice to be on the sidelines or not be against this trend if it's falling. And they're like, I can actually sleep at night. This makes so much sense. And we know when we're getting into a trade, a few several days before. We also know when things are weakening that we're going to be exiting soon. There's no big like shock and awe of something happens like that. And everybody's, oh my gosh, the strategy, we see these waves coming and going. They don't happen overnight. And that's the nice thing about it. We pay a little higher taxes on returns, but we also make higher returns on average above what most other strategies do. Plus, you get the benefit of security, of mental peace, of health, a lot that goes with it, because stress is extremely dangerous. And in 2008, the financial crisis, there was, I think it was 7,100 people committed suicide in 2008, 2009, directly linked to falling stock prices. That's how dangerous a bear market is. People who haven't been through it, which is a majority of investors and traders right now, so many new people came in after COVID. They have no idea when it happens, what they're walking into. And that is what I want people to avoid. Not only that, but we grow our wealth while the market falls. And that is the craziest, weirdest, exhilarating feeling ever, is to see everything falling apart. And you're like, I want stuff to keep falling because we're benefiting from this chaos. And then we have more capital than we've ever had during a market bottom, and we can reinvest our new high kind of net wealth into the new bull market that could last 5 or 10 years. So it's a very different scenario and strategy that I do. And yeah, from a tax perspective, we pay a little bit higher taxes, but we also make higher returns to counter it. And it comes with a lot of benefits on the side.
Yeah. Yeah, I know, because I know a lot of individuals listening to this, they want to make as much as they can possibly and save on excess taxes. And so next question I have for you is, you also have this area where it's like active trading, where you can pay attention to certain market signal sentiment, and you also have auto trading. How do you combine these two, and how does AI play a role in your strategy?
Yeah, so there's a couple of ways, or a few ways to trade our strategy. So the strategy, which I call the ACS strategy, it's called the adaptive compounding strategy. So we adapt with the market conditions, we reinvest our capital, so we're compounding our growth at a much faster rate. There's a few ways to trade. The first one is you can join it as just a flat rate newsletter. You just subscribe, you get access to the exact trades that I put on. My whole service and my strategy is my portfolio. I share the exact trades, portfolio allocations. It's not like I'm dishing out trades to satisfy people. That's typically the newsletter industry, is I'm going to push out all these fancy trades and everybody's going to get excited. I do the opposite. My strategy is as boring as hell. It's like watching paint dry. But once you realize the value and you experience it, people are like, oh my gosh, this is the best thing ever. And I can go live life and do other stuff. So long story short is, you can copy my ETF trades. So when we have one of these 5 to 12 trades a year, I issue an alert. It goes out by email, by our mobile app, and into our members area. And it says, buy this ETF with 50% portfolio allocation. Here's our first target. Here's our protective stop. And then more or less, I just update each day or a couple times a week through that position. And when we hit a target, I let people know, hey, I'm selling off half of this position. I'm going to lock in some gains. I'm going to move my stop up. So if you want to trade and get into that space, because it is a rush, it is fun to trade, there's no doubt about it, then you can do that. The other, as you mentioned, Christopher, is the auto trading. So there's a broker where if you were to open a brokerage account, move your money over with them, they execute the trades for you. So it's just set it and forget it. Just be the professional that you are, do what you enjoy doing, make money there and enjoy your free time, and just let the strategy run as almost like a side business, right? It's making you money and growing on the side in all market conditions. And then we do work with financial advisors. So if you still want a full-on advisor, a fiduciary responsible advisor who can do it, there are some that actually will execute our trades for you. So you have that layer of assets under management and somebody following it that way. So we have the whole kind of gauntlet, whatever fits your criteria. And you can put as much or as little as you want with the strategy. Most people start off with a smaller amount. And then after they see the value, believe it or not, it takes about 9 months for people to see the value in our system because it's fairly slow. And the market has to go through a certain situation where they're like, holy, I see exactly why you do what you do now. Like, you just saved me a fortune, or we just made money on that. I cannot believe that. So it takes time for people to see the value. And once they see the value, they get the confidence and the comfort. And then they're like, okay, I'm putting more to work. And so that's pretty much how that whole process usually unfolds.
Interesting. I know the markets are quite interesting these days. We got geopolitical market uncertainties. I know, again, for the audience, this is not advice. We're just discussing is this rally going to continue? Are we in a dead cat bounce? And also want to hear your thoughts because I want to get your thoughts on how you view Bitcoin.
Yeah. So looking back at the market in terms of, are we in a bounce? Are we in a rally? Originally, I thought it was going to be a bounce, and it was a bounce, and now it's turned into a rally. And now the markets are testing and hitting all-time highs. So there's nothing wrong with that. Once the market switched from a bounce to a rally based on technical analysis. So I don't know if we haven't really touched on this yet, but I'm a technical trader, which means I focus on technical analysis, which means I read price charts, volume, sentiment, cycles, things like that. I don't look at the news. I don't use fundamental or economic data, none of that. And long story short, I learned during the first bear market in 2000, when I went through that one, when I blew up my first account, I learned that fundamentals don't actually work. So I was holding and buying the best stocks at that time. I was trading small cap stocks. They were growing quarter after quarter, yet their stock price literally fell 50 to 85% in that bear market, even though they were they were strong companies. And that was when it hit me. I'm like, okay, I just lost all my money holding the world's strongest and best companies. There is something flawed with fundamental analysis. And that was when I realized you can't fight the trend of the market. If the tide is going down, you can't hold your boat up unless you got a lot of ropes on that dock and it's a strong dock to keep it hanging. But so I go to technicals. I follow price. As an investor, all of us make money when price moves in the direction we want. Usually we buy stuff we want to go up in value. So generally, if something's going up, we identify it, we follow it. So I can't remember what your basic question was there. I went off onto a rant, but I want people to understand I read the charts and follow the money versus follow what other stuff is saying.
Yeah. Yeah. And I know because, we have a looming, like that 90-day tariff pause and markets are up significantly today. One thing, again, we can't predict. What are your thoughts on the US dollar, gold, Bitcoin, and oil?
Yeah. So I remember the question now. So the first question was, we went from a bounce to a rally, and now the stock market is hitting new all-time highs. So we still want the markets to go high because we're long. So the market went from a bounce to a rally. And because we use technicals, we said, okay, if it's in a rally, we want to own it. So we're back into the stock market. Your other question was on Bitcoin. I like Bitcoin. One of our strategies is actually holding Bitcoin, and it looks like it has a lot of potential, about 25% upside potential. So I'm not a crypto fan really, but we've had a couple trades in crypto over the past year that have played out very well because the chart has just got these incredible patterns showing huge strength. And so I'm bullish on Bitcoin. I don't own it. I don't own it as a short-term trade. I own some from a decade ago, but one of our strategies is holding it. In terms of the other asset classes, the dollar, we've seen the US dollar get hit very hard. People are boycotting the United States. They're boycotting the dollar. Everybody's like dumping the dollar. It's been hit very hard. A lot of it obviously coming from the whole tariff stuff, but the falling dollar has helped lift commodities. We've seen gold really skyrocket. It's been on fire. And typically when we get into a very nervous environment, obviously wars going on, we've got economic data is starting to get mixed. I think it's slowly coming to an end. And I think we're going to enter into a recession and a bear market at some point this year. Interesting. When people get nervous with all this stuff, they tend to move into gold. And so gold naturally was doing well, but then the dollar got hit. And as the dollar falls, gold rockets in US dollar value. So gold is showing us a defensive move. And when gold moves the way it has been moving over the past year and a half, it's a huge warning sign that we are getting close to a global reset, not just in the States, but it's going to be a global reset. And we saw this back in 2007, 2008, almost identical chart patterns, price action. I'm bullish on gold. I do think eventually it'll sell off when we go into a recession. Gold typically gets sold with it, but at this point, it's in a strong uptrend. You want to hold gold, and the dollar is trying to find support. I do think eventually the dollar will find support and have a big bounce. Mm-hmm. I think a lot of people have been shorting the heck out of the dollar, meaning they want it to go down. They're profiting from it. And it's one of the most hated assets, I think. Anytime I give a bullish opinion on the dollar, man, I just get hammered with all kinds of comments of how wrong I am and how the dollar is going to zero. So that to me is actually a very bullish sign. I have this indicator called the inbox indicator. And we get hundreds and thousands of emails actually a month. And so we can actually see what the messages are. We can tell the bias of the general public. And so when everybody's like, really bearish on something or all worried about one particular thing, usually the opposite is going to happen. And that's where we were at with the dollar. As everybody says the dollar is going down, which means the dollar rallies. It typically means the economy, the world economy is actually crumbling and falling. And we're going into a recession and we're going into a bear market in stocks. And the dollar usually survives and actually thrives. So we're getting very close to this scenario. Gold's the big warning sign. Undervalued dollar, the most hated currency of all time right now is the dollar. We're at those extremes and we're just waiting for the music to come to an end and a recession to start, which was why people need to protect their capital, because the buy and hold strategy, I don't care what advisor says, oh, they have some hedging and we've got some things in place. There's no really financial advisor that is actually going to have a strategy that will profit and grow your account in a falling market. Almost everything goes down. You have to have a different strategy. So that's why I wrote this book, why I'm sharing it, because the markets have this way of hurting the most amount of people at the worst possible time. And I believe we have the largest group of people with wealth and baby boomers, all in retirement, close to retirement, and they're going to be the group that gets hit the most. They're all doing old school buy and hold investing. They don't realize they're holding a ticking time bomb for their life savings or retirement accounts. And that's what my whole book is about, is how to avoid and protect yourself, because it's way better to make no more money for the next 5 years than it is to lose half of your wealth and struggle for 5 years. Like earning 4% on the sidelines, you'd look like a superhero if the markets crashed. But people think that cash is not a position. They think it's nothing. They're not going to keep up with inflation. I'm like, hey, it's either eventually you're going to lose 30 to 50%, or you can avoid it or actually benefit from it. You just have to decide what kind of action you want. Or you can ride the roller coaster like everyone will, pretty much, unfortunately.
Yeah, interesting. Yeah, because the most common story I hear these days is people quit their job or they retired and all of a sudden they're hit with, especially back in March and April, they just their portfolios took a 30-40% hit, and it's just, and then they're scared, are they gonna outlive their savings and investments? And the one last question before we go is, the audience is asking, what do you think about oil? Is the price predictive with wars and uncertainty? How are you viewing oil?
Yeah, so I've been bearish on oil for a while. It's clearly still in a downtrend. Recently, it had a big pop with the bombings, Iran, and all that stuff. There was a big news-driven move in oil, but it quickly just went right back down, back to a resistance area. So oil typically leads the economy. I think usually we see a big rally in oil, which we had a little a month, two years ago already. It usually spikes up and then we see it fade and go into a downtrend. And so the way oil's been moving is just showing that overall the economy, I think, is going to be slowing. There's going to be less demand. Obviously, there's lots of oil being pumped into the markets, which doesn't help either. Oil, to me, I think is going to $55 or $45 a barrel over the next year or so. And that's because we're going to see demand, a recession kick in. Things are going to slow right down. Obviously, if war stuff picks up even more, then we could see oil spike. Gold and oil tend to do well in times of war. But as you can see, what goes straight up on news or war stuff, it can come straight back down very quickly within a week. So you have to be very careful. I'm not a fan of trading oil simply because it is very volatile in this market condition. It can move 5 to 20% in a day or two. And I don't like to ever expose my portfolio to something that moves that fast. We don't need to take that type of risk. It's how can we pull money out of this market and not panic and not sweat if the worst case scenario hits? So everything we trade is designed that if the worst thing happened to the markets, we're not going to get slaughtered. We're going to be oh, that kind of hurt a little bit, but man, it could have been so much worse if we did anything else, right? Well, I would steer clear of oil. Right now, it's painting a picture of recession coming, weaker times, which is an opportunity. The way I see it is, I think people who have accumulated wealth, if you can preserve your wealth over the next couple of years, you will, if you can keep it and not give it back in a bear market, you're going to have all this money to reinvest into real estate, into stocks, dividend paying stocks that are fair valued, have lots of upside potential, huge yields. You'll be able to buy businesses, equipment, toys, whatever you want, because most people, when you go into a recession, people lose money. They sell all their stuff. They take losses. If you can avoid all of that and keep your wealth, just think of all the stuff you can accumulate or buy. I love real estate. I'm into multifamily real estate. I own self-storage. I have different businesses. And it's a time that you can pick up amazing assets that are real estate is amazing. I don't believe it's a good value yet, but in a year or two from now, real estate could be absolutely amazing where the numbers make sense. You can pick the property that fits, that's close to you, that fits your lifestyle or multifamily or something, and actually have it cash flow positive and not buy lipstick on a pig, some old skeleton, overpriced, just squished in basement apartment. You can actually buy something that's nice that'll last you 10, 20 years of income and continue to double, triple in value over time.
Yeah. How can people connect with you and check out your services, your books and courses, your blog, and learn more from you?
Sure. Yeah. The best way would be to go to YouTube, just search The Technical Traders, or you can go to my website, thetechnicaltraders.com, and type in my name. You'll see a million interviews. I talk about the markets and real estate and different stuff all the time. But if you go to my website, I do have a free newsletter. You can get on and you'll get my update reports on the markets and real estate and all that stuff every week. And if you're interested in what I do, you'll see my newsletter, the strategy that we deploy, and you can either do it yourself or have it done for you with some or all of your capital and not have to stress about the future really when it comes to the finance side.
Excellent. I really enjoyed this talk and really timely. And thanks so much for coming on and adding so much value to the audience.
Have a pleasure, Christopher. Thanks for having me. Always a pleasure.